Welcome back, financial adventurers, to Am I Catching a Falling Knife? The podcast where we sift through the market's recent tumbles to find out if there's a real bargain hidden beneath the headlines, or if we should just steer clear. I'm your host, Dave, and today we're putting a spotlight on a company that's absolutely vital to the tech world, yet has seen its stock take a significant hit recently. We're talking about ASML, ticker ASML, which has dropped a noticeable 9.60% in just the last 10 days. So, is ASML a falling knife we should be avoiding, or is this a golden opportunity for the intrepid long-term investor? Let's find out. All right, folks, let's dive deep into ASML, ticker ASML, a true titan in the semiconductor world, and see if it's a falling knife or a potential bargain. Now, over the last 10 days, ASML has seen a pretty significant drop, down 9.60%. Ouch! So, what's the story here? Well, the single most dominant market narrative driving ASML's price action right now isn't about some fundamental flaw, but rather the company's own cautious 2026 outlook and a slightly reduced 2025 forecast. This is largely due to macroeconomic and geopolitical uncertainties swirling around, and it's overshadowing some genuinely strong Q2 2025 earnings and even the huge demand coming from AI. This uncertainty, especially about a potential growth stall in 2026, has led to these significant stock drops, even though their current performance is robust. So, what exactly is ASML? ASML Holding NV is basically the unsung hero behind almost every microchip on the planet. They are the leading global supplier of complex lithography systems, which are absolutely critical for making those tiny integrated circuits that power everything from your smartphone to advanced AI servers. Their technology is what allows microchips to keep getting smaller and more powerful. They make their money primarily from selling new systems, which makes up a whopping 85.2% of their revenue, but also from services and field options. Geographically, they're truly global, with a significant presence in China at 37.8% of revenue, Korea at 23.8%, and the US at 16.8%. They're also heavily investing in capacity and technology, including the cutting-edge high-NA EUV systems, getting ready for the next big wave of demand. Now, let's get into the numbers. So, how did we get to that estimated earnings impact number? Let's break it down step by step. First off, the market narrative explicitly talked about a reduced 2025 forecast and a cautious 2026 outlook. What does that mean for their revenue? It signals a downward revision in what they expect to bring in over the next few quarters due to those macro and geopolitical headwinds. Second, ASML's bread and butter, their net system sales, which is 85.2% of their total revenue, is the segment most sensitive to these demand changes. It's the biggest lever for their top-line performance. Third, given the significant stock drops mentioned, we estimated that this reduced forecast implies about a 6.0% lower total revenue for the upcoming quarter compared to what the market was previously expecting. Fourth, ASML has a solid gross margin, around 53.99%. So, if their total revenue drops by 6.0%, that's pretty much a direct 6.0% hit to their gross profit. And finally, because ASML has high fixed operating costs, think massive R&D, sales, and administrative expenses needed for their incredibly complex manufacturing and service model, a percentage change in gross profit typically leads to a proportionally larger percentage change in net earnings. We call this operating leverage. Based on typical industry dynamics for high-tech manufacturing, we estimated this leverage to be roughly 2.0x. So, if you combine that 6.0% gross profit impact with a 2.0 show operating leverage, you get an estimated 12% reduction from previous earnings expectations for the upcoming quarter. We put that confidence interval between a 9.5% and 14.5% hit, as estimating the exact impact of caution and uncertainty isn't an exact science, but the underlying AI demand does provide some floor here. So, what does that mean for the stock's value? When I ran my discounted cash flow, or DCF model, I used some key assumptions. We're looking at an analyst projected growth rate of about 20.64% for the next 5 years, a discount rate of 9.5%, that's our required rate of return, and a terminal growth rate of 2.5% into perpetuity. Based on those assumptions, the model gave us a base case fair value of around $796.53 per share. But when we factor in that 12% hit to future earnings based on our narrative analysis, the fair value drops to about $681.04. Considering ASML's current price around $725.08, that narrative adjusted value suggests there might still be some room to fall. For context, the average analyst target price is significantly higher at $835.52. Now, if you're looking for potential entry points, my custom buy levels are set at $650, $530, and $440. These are points where the risk-reward starts looking much more attractive based on deeper fundamental valuation considerations. So, there you have it, folks. As always, this isn't financial advice. It's just my take, Dave's take on the data. Do your own research, connect with a financial advisor, and make the best decisions for your portfolio. Thanks for tuning in to Am I Catching a Falling Knife? We'll catch you next time.